Hi, you know what? We have Michelle Kole of Kole Reverse Mortgage. She's going to be talking to us about the 3 ways to fund a better retirement. Michelle, welcome to the show.
Thank you, Steve. It's such a pleasure to be here.
You know what? Congratulations. You just got one married off, or the last one married off?
Yes, in gorgeous Lake Tahoe last week. It was awesome.
From a parent standpoint, that just means one less on the payroll, right?
Yeah, love it, love it. As long as I don't come back, but yes.
If they do come back,
they do. They all come back at least once, but yeah, it's great.
So let's talk about reverse mortgages when it
Yes.
comes to funding a better retirement.
Yes.
So tell us about that.
Well, there's really 3 ways to use a reverse mortgage. You can pay off an existing mortgage, and then you have no mortgage payments. Of course, that's the best thing about reverse mortgages, is that there's no more principal and interest payment. So each way gives you access to more cash. Either when you pay off your reverse mortgage or you pay off your existing loan, then that cash that you were spending to write that monthly mortgage payment, you no longer are doing. Or maybe you want to set up a line of credit for the future. You don't need the payments right now, or maybe you do, but that gives you access to more money in the future. And as a financial planner, that's what you want to do, is give people options so that they have another strategy for retirement. Then you have buying a home with a reverse mortgage. One of the best things about buying a home with a reverse mortgage is there's no payments, principal and interest payments, and many times, rather than buying a home with all cash, you can save part of your cash for other things that you want to do, and no monthly mortgage payments, the house that you really want. So that's kind of 3 things that people do with reverse mortgages.
So let me add to that, as somebody who's a financial professional helping out people every day. One of the big things that we're seeing now is pensions.
Yes.
We're starting to see, we have the truckers' pension. They were going to reduce the amount of payments so the pension would last longer, but the Treasury said, sorry, not going to happen. So we've got a truckers' pension. If they don't make any changes, we'll be gone in 12 years. There's a merchant marine pension. These are the guys who make all the stuff that come in off the boats work, because they work on those boats, and that's going to be gone in 8 years. And we're starting to see issues just recently in Detroit, Michigan, where people lost a lump of their retirement pension because of the city's problems with money. And we're seeing those pensions get compressed. And you know what? If you really look at it, I have one client that he figured out that if he got a reverse mortgage now, 8 years from now, the balance in the reverse mortgage, he started with $300, would be about $480,000.
That's right.
So he would be able to use that $480,000 to supplement it, which is really big because, you know, I said 300, now it's 480. That means that reverse equity line grows. And then here's the next one. Long-term care. People are definitely afraid of being able to afford the cost of health. And here's what I've also seen, where people say, you know what, I don't need it right now. Not at all, okay? But I want to go live the life, and I want to go spend some of this money I've been saving or create an income from it so I can go travel, help out my grandkids with college. And what they're doing is they say, hey, I've got a $300,000 reverse mortgage that grows by 5.4%, and it'll grow by even more when interest rates go up.
Absolutely.
But when I'm 82, it's almost $1 million, and that's going to cover me and my wife for that long-term care expense. Yeah, kids won't get as much, but we'll be able to live the life we want. Now, one of the big things is we see a lot of people right-sizing.
Yes,
okay?
yes.
And they've got this big old house and lots of cash in that house, but not a lot of retirement assets. So they right-size to a smaller property. How do they go about using a reverse mortgage to buy a property? Is there limits to it?
Yes, yes. Whether you're using it to buy a home or refinance, the amount that you have access to is determined by your age and the value of the property. The older you are, the more loan you can get. So if you're, it ranges anywhere from 50% of the value of the property up to 75%. So if you're 90 and up, your loan to value per se is 75%. So older folks that are waiting till later to buy another home, they have access to that much more, so they get to keep more cash in their pocket.
So what is the actual limit on a reverse mortgage? How high can it go?
The cap, most reverse mortgages are federally insured, and they call them home equity conversion mortgage, or HECM.
Okay.
And those particular ones have a cap of $625,500. So you can buy a home up to that value. That's what the loan will be based on. However, you could buy a larger home that's greater than that value. It just means you'd have to bring in more cash. So to determine the loan amount, the cap is $625,500.
Okay, so in other words, if you're buying a house for $625,500,
yes,
you can get 75% of that if you're 90 years old,
if you're
obviously.
90 years old, yes.
And then you could save your other cash for health issues, travel, grandkids, the whole shot.
Yeah.
Giving early inheritance and everything.
Yes.
Perfect. Now, let's see. One last thing. When somebody walks out on life, what are the relatives' options? Can they buy it? Are they just done with it?
Oh, yeah.
What's the options?
There really are quite a few options, Steve. First of all, if they pass away, the family members can inherit the home like any other property. They refinance, they pay off that mortgage, they sell the property. A reverse mortgage is still a mortgage. So just like in any other home, generally the heirs will sell it and then split whatever equity is there. But say even if there wasn't any equity, which that could happen if they've lived there a long time, the heirs can still buy that property for 95% of the appraised value at that time, the market value, regardless of the amount of the loan. Even if the loan exceeded the value, they are not liable for it. And that's really huge because there's no recourse. So that means that the heirs, if they really want to buy the home, could do that. The mortgage insurance that's covered by FHA pays off any difference. So nobody's liable.
That's good to know. Michelle, thank you so much for being part of our show today.
You are so welcome.
And providing this information because it makes a difference in people's lives.
Yes. Thank you.
Now, for more information, you want to go to the Silver Hair Tsunami website or go to Kole Reverse Mortgage. Stick with us. We'll be right back.